Top 5 mistakes new investors make and how to avoid them. Imagine planting a tree, then digging it up every few weeks to check if it's growing. That's what many investors do. And just like the tree dies, so does the investment. If you're new to investing, this video could save you from some painful mistakes, as we'll break down the top 5 mistakes new investors make, the kind that silently drain your profits and shake your confidence. But don't worry, we're not just listing problems. We'll also show you how to avoid them in simple language so you can grow your money with peace of mind and purpose. So let's get started. Top 5 mistakes new investors make. Number 1, investing without understanding. One of the biggest mistakes beginner investors make is putting money into something they don't fully understand. It's easy to hear about a company doing well or see a stock going up and feel like it's a good idea to join in. But investing isn't guessing, it's decision making. And good decisions need clear understanding. When you invest in something you barely know, you're not investing, you're hoping. You might not understand what the company actually does, how it makes money, or what risks it's exposed to. That lack of clarity leaves you vulnerable. If the stock suddenly drops or the news turns negative, panic sets in. Why is that? It's because you never had a firm grip in the first place. You were relying on surface level information, a headline, a tip, or a friend's excitement, and not your informed judgment. The bigger problem is when you don't understand the business, you can never tell whether a drop is a small bump or a sign of real trouble. You also don't know when it's the right time to stay in or get out. And that can cost you not just money, but confidence. Number 2, letting emotions guide your moves. It's hard to stay calm when money is involved. The stock market goes up and you feel excited. It dips and suddenly you're filled with fear. This emotional roller coaster is something every investor faces, but beginners often let their emotions take the wheel. You might buy a stock just because everyone else is doing it, afraid of missing out. Or worse, you might panic sell the moment things start to drop just to stop the discomfort. In both cases, emotions, not logic, are calling the shots. The truth is, emotional decisions often feel right in the moment, but end up causing the most regret. You tell yourself you're protecting your money or chasing an opportunity, but really you're just reacting. It's like trying to drive in a storm without wipers. You can't see clearly and every turn feels risky. Letting fear or excitement make your decisions leads to a cycle of bad timing, missed chances, and lost growth. The market rewards patience, not panic. And when your emotions keep shifting, it's almost impossible to stay focused on your long-term goals. Number 3, trying to time the market. Many new investors fall into the trap of thinking they can outsmart the market. The idea sounds simple: buy when prices are low, sell when they're high. But in reality, trying to guess the perfect moment to jump in or out almost always backfires. Markets are unpredictable, and even the experts get it wrong. You might think a stock will drop further, so you wait and miss a big rally. Or you sell too soon out of fear, only to watch the price climb higher the next day. Timing the market often feels smart at the time, but it turns investing into a game of guesses and luck. Instead of building long-term growth, you're stuck reacting to every twist and turn. This kind of strategy can also keep you constantly worried, checking prices every hour and second-guessing every move. And over time, that stress adds up. Worse still, missing just a few of the market's best performing days, which often come right after big drops, can hurt your overall returns more than you expect. Number 4, neglecting diversification and balance. It's easy to put your money into something that feels familiar or exciting, maybe a trending stock, a booming industry, or even a company you admire. But when all your money is riding on just one area, you're taking a bigger risk than you might realize. If that one investment drops, your entire portfolio takes the hit. That's what makes diversification so important. It's like not relying on one income source to pay all your bills. That is, you spread your risk. But even if you start off diversified, things change. Some investments grow faster than others, and over time, your portfolio can get out of balance. Without regular check ins, you might end up too heavy in one area without meaning to. Then a sudden market shift hits, and it hits harder than it should have. Many beginners assume set it and forget it will work forever. But investing needs attention. Diversification isn't about playing it safe, it's about being smart and steady. It helps you protect your progress and smooth out the bumps along the way. Number 5, lacking a clear financial plan. Many new investors jump in with excitement but have no idea of where they're going. They invest because they feel they should or because someone told them it's smart. But they haven't really asked themselves the deeper questions. What am I investing for? When will I need this money? How much risk can I actually live with? Without these answers, every investment feels like a shot in the dark. You might pull out too early, hold on too long, or choose things that don't suit your life at all. It's like packing a bag without knowing the destination. You'll likely end up unprepared. A clear plan brings direction. It helps you figure out what kind of investments make sense for your timeline, your income, and your long-term goals. It also makes it easier to stay calm when the market gets shaky because you know why you're in it and what you're working toward. Without a plan, every bump feels like a crisis. But with a plan, you can stay focused, even when things get tough. Remember, investment isn't just about growing money. It's about giving your money a purpose. How to avoid the mistakes. Now that we've uncovered these 5 costly mistakes, let's talk about how to avoid them clearly and confidently. First, to avoid the trap of investing blindly, start by understanding your foundation. Don't invest in anything you can't explain in simple language. Research the company, fund, or asset type before committing your money. You don't need to become a financial analyst, just aim to know how your investment works, how it makes money, and what could cause it to lose value. The more clarity you have, the more confident you'll be. This habit reduces panic during market dips and helps you hold investments for the right reasons, not because they're popular, but because they truly make sense. Next, to prevent emotions from running your portfolio, build in pauses between thought and action. When fear or excitement hits, don't rush to buy or sell. Take a breath, review your plan, and ask whether your decision matches your long-term goals. Emotional investment often feels urgent, but the best moves are usually the quiet, patient ones. Setting boundaries for yourself, like not checking your investments daily, can help. It's also wise to journal your thoughts before reacting. Over time, you'll notice that staying calm, even when the market isn't, gives you an advantage most investors overlook: peace of mind. Another important shift is letting go of the idea that you can perfectly time the market. Even the most experienced investors get it wrong. Instead of waiting for the perfect moment to buy or sell, focus on staying consistent. Regular investing, even in small amounts, often beats trying to jump in and out. When you stop chasing timing and start building habits, you reduce stress and avoid the emotional highs and lows. Accept that short-term drops are part of the process. What matters most is staying invested long enough to let compound growth do its work quietly in the background. Equally important is making sure your investments are spread out and regularly checked. Putting all your money into one stock, one sector, or even one country creates a risk you may not see coming. Diversifying means owning different kinds of investments, so if one falls, others may rise or stay steady. But diversification isn't something you do once. Over time, your portfolio can drift. Rebalancing, checking in, and adjusting helps you stay aligned with your goals and risk level. It's like steering a car. Small corrections keep you on course, even when the road changes or unexpected turns appear. Finally, everything becomes clearer when you have a real plan behind your investments. Know what you're aiming for, whether it's retirement, a home, or your child's future. Once you understand your goals, your risk comfort, and your timeline, your investment choices become easier to make and stick with. A clear plan helps you ignore noise and focus on what actually matters. Without one, it's easy to drift, copy others, or panic when things shift. But with a plan, you always have something to come back to, a reminder of what you're building and why you started in the first place. So basically, investing doesn't have to be complicated or overwhelming. Most of the costly mistakes beginners make come from rushing in without clarity, reacting without thinking, or trying to do too much, too fast. But now, you know better. With a little patience, a clear plan, and steady habits, you can avoid the noise and grow your money with confidence. Did you find this video helpful? Don't forget to give it a like and share it with someone who's just starting their investment journey. If you have questions or want to learn more, drop a comment below. We'll definitely answer you promptly and satisfactorily. See you in the next video.